Hi, I'm Alex with Simpler Trading. I'm here to provide you with some tips when it comes to trading volatility. This video is going to be short, sweet, and to the point, so without any further ado, let's dig right into it. Move myself out of the way here for you. The first question that needs to be answered is, what is volatility? Volatility is the rate at which the price of a stock increases or decreases over a particular period of time. Higher stock price volatility often means higher risk and helps an investor estimate the fluctuations that may happen in the future. Oftentimes, when volatility is low, that will help the market trend in an upward direction. And when volatility is rising and going to extremes, that will help the market trend in a downward direction. So you may be asking, how can you gauge volatility? Well, volatility can be gauged by using VIX. VIX is the volatility index. Yes, VIX is tradable, and yes, VIX does have options. So how do you read VIX? When VIX is going up or VIX is rising, that means volatility is going up and volatility is rising. When VIX is going down, that means there's less volatility and volatility is going lower as well. As I mentioned in the previous slide, oftentimes when VIX is going up, that means the market is going down. They are the opposite of each other. A lot of our traders here at Simpler Trading like to use ATR when it comes to their trading strategies. So if you're familiar with ATR, you may be wondering, how does volatility affect ATR? And if you're new to ATR, ATR stands for the average true range. The average true range means the average range that the underlying equity moves in a day. And the answer to the first question is high volatility, ATR will typically rise. So what causes volatility? The three big things that cause volatility is going to be news, economical data, and the date that it is released, and earnings. So for news, it may be sudden, it may be out of nowhere. For economical date and earnings leading into the date of earnings or the economical data, it may cause volatility to rise, or the data that comes out itself or the earnings report itself may cause a spike or a decrease in volatility. So how can you trade volatility? Volatility is very important to lower the time frame of your trades. You should probably be looking for shorter term trades in high volatility. Why? That is because in volatility, there's going to be a lot of quick and violent price action movements. So you should understand that, look to take profits when they are there. A couple strategies that can be benefited from volatility and that do well in volatility are going to be scalping and day trading, because they are both looking at a shorter time frame when it comes to the trade. Another strategy that does very well in high volatility is going to be vertical credit spreads. So thank you for watching. Once again, I'm Alex with Simpler Trading. We hope you have a great rest of your day. Thank you.